Hello, everyone, and welcome to the Humans Behind the Handles podcast. In the coming months, through a series of conversations, we're going to speak with retail investors who come from various different backgrounds and invest in a variety of different ways. The goal of these conversations is to get to know the humans behind the handles, to show you that it doesn't matter who you are or where you come from. If you put in the time and effort like our guests, you too can become a successful investor. We hope to give these investors a platform and a stage to show the world just who they are, how they got here, and what their process is. Now, today our guest is Alex Morris, who runs a Substack with the name of TSOH Investment Research Services. Alex has a long-term mindset focusing on businesses with deep moats and management teams that are focused on investing in the future of their business and not playing the quarterly earnings game. We also discuss his journey in terms of how he arrived at having this philosophy, and also some of the advantages that retail investors have over professional money managers. Now, without further ado, let's get started. All right, Alex, how's it going today? Here that we're catching you on the road. You're doing a road trip right now, so appreciate you taking the time to join us. You go under in Twitter, you're TSOH Investing, and you have a Substack, the Science of Hitting Research Service, which for anybody that hasn't checked it out should definitely check it out. To start, I was just hoping if you could kind of talk to us a little bit about your general investment philosophy and kind of how you approach investing. And just kind of give a broad overview for folks that haven't had a chance to check out your Twitter and your Substack.
Sure. Well, thanks for having me, first of all. My investment philosophy, more than anything else, is focused on the long term. And that influences everything I think about and everything I do as an investor. And I think that idea really got planted in my mind, luckily, at a young age as an investor, or when I started investing. Really, the idea of a stock being an ownership position in a business, as opposed to just a ticker symbol that goes up 2% or down 2% every single day. So my philosophy starts with the idea when I invest in a company, I do so with the intention of owning it for a very long period of time, which may be 2 years, or in some cases I have positions now that I've held for over a decade. So that's kind of the approach that I start with. And what I've found over time is that way of thinking greatly influences the kind of things that I focus on, the kind of things I care about as I look at day-to-day news or what other people are talking about. And honestly, it leads to much of that stuff really being noise. And it's required me over time to kind of adjust how I, take in the news fire hose that's constantly hitting us in the face with new information, and just ensuring that I'm actually having a plan for digesting all this content that's actually additive to the way I think about the world. So I've had to make some adjustments as a result of that, but I think it puts me in a position where I really can focus on what I think is most important over the long term.
So how do you do you have any kind of method, or I don't want to call it a method or a process, but a routine in the way that you consume news and things like that prevents you from maybe being too reactionary or anything like that? Are you not checking it all day, or only a couple times a day, or only use certain services? How do you sort
Yeah, I really try to limit what I consume, and mostly it's, for example, if a company reports earnings, I'm not reading articles about how Microsoft's EPS or revenues compared to what the street was looking for. Like, stuff like that to me is basically completely useless. And you see good examples of that from time to time. For example, a company will come out and say, hey, for next quarter or the rest of the year, we think margins are going to be below what we had guided to previously, because we're investing more aggressively because the opportunity ahead of us is bigger than we previously appreciated. Like, that's obviously good news for any long-term investor. The fact that it means EPS is going to come down by a dime to me is irrelevant. So it's just trying to get stuff like that out of my news flow. What that leads me to do more often is to read. Bloomberg and the Wall Street Journal, for example, will do really good jobs of having long, more like profiles of companies or of management teams. And I think those type of articles can be a lot more insightful and provide a lot more information that's actually additive to my process. Outside of that, I really try to stick to more of the source documents and, things that are focused on the longer term of the business, things like investor days where a company will really lay out, hey, here's what's happened over the past 5 years. Here's where we're trying to go over the next 5 to 10 years. The focus of those conversations is almost always more long term than what you'll get during the Q&A on, a quarterly call.
Yeah, that's what I was. I'm glad you brought that up because that was something that I was thinking. Is that oftentimes, the management team on a call on an earnings call, for those, every company does an earnings call, and almost every company actually do know a few that don't do live Q&A, but they do a question and answer session with analysts. So you don't pay too much attention to the question and answer, or do you kind of filter through it? Because sometimes the company does kind of present things through a rose color, kind of colored glasses. And sometimes analysts can kind of ask some hard questions and kind of, it can be fundamental. It doesn't just have to be, month to month. If a management team's not executing on plans that they previously kind of had made and they're kind of trying to skirt around it. How do you filter through that?
So the way I consume those, and this has changed over time. First of all, I never listen to the calls live. I always listen to the replay because I want to have a transcript in front of me so I can read along with what they're saying. And that gives me the ability to hop forward or pause and come back when I need to. And that process for me allows me to really step back and say, okay, is this important short term, long term? And obviously a lot of this stuff isn't black or white. It lives somewhere in the middle. But is this important short term, long term? Is what management just said about topic XYZ, is that similar to how they've talked about it in the past? And I can easily pause and go check how they talked about it in the past. So I'm really looking in those things, again, less of like a pinpoint number and more of consistency in the way that management's thinking about the business. Have they changed their tune on something? If so, why? That's really the kind of stuff that I'm looking for. And when the third analyst on the call asks about, gross margins being down 50 bips next quarter, I can just skip ahead a minute.
Right. Just don't even let that pollute your mind with that kind of nonsense that Wall Street so often is focused on the next quarter, or the next 2 quarters, or whatever it may be.
Even by the way, even the idea of management entertaining those discussions and how they respond to it, to me, is a very important signal. It gives me insight into whether or not this management team is thinking about this business in the way that I am, which is I don't care about earnings for the next 3 months if they're up or down 10% versus estimates. I want them making intelligent long-term investment decisions and riding the waves of short-term outside pressures to the best of their ability.
Have you seen that? Have there been companies that you really liked the business and things like that, and then you started hearing that creep? Because I think it is a very tough thing for management. I mean, it shows their ability to not give way to that pressure of the analysts, because they have bankers in their ears all the time. They have research analysts in their ears all the time. It is a very difficult thing for them to do. But have you found that before? Like you're literally witnessing a management team drift.
Yeah, a lot of times it'll be on the margin, right? Like for example, a one that came up recently, which isn't a huge knock on the business, but it's something that stood out to me is Comcast. They're building a new park in the NBCU division in Orlando, and during the pandemic, they basically took their foot off the gas and stopped building it for I can't remember how long, 6 months or a year maybe. And in terms of the company's I know it was a very unique time, obviously, but in terms of the company's financial position and the results they were seeing in their core business, it wasn't something that they actually really needed to do. And they've subsequently said, hey, maybe we shouldn't have taken our foot off the gas. But it's a small thing like that to me that's just like, I don't know if I totally agree with that type of decision, because I think it was partly done in terms of, kind of the optics of what the short-term
next month
P&L or cash flow statements.
Yeah,
it was kind of done in that light. So that's a small thing, but those are the kind of things that stand out to me. And I think you see it in other parts of Comcast business where, for example, with Peacock at NBCU, the pace of decision making and the pace of investment has been a little bit too slow, and it's put them in a position where it's difficult to win. At the same time, really aggressively going after that opportunity would have materially hit the P&L in the short term. So you can recognize why the decision is difficult, but it can put you in a place where you're not well positioned strategically.
Do you? This is in terms of incentives, and I think this is an area that maybe people are unaware of at times, but sometimes, and this isn't always the case, management has incentives, literally stock, grants and things like that, vesting schedules that are based on shorter term performance, which is like a kind of a boring thing to search through in filings and try to find. It's normally in proxy statements, which, if folks don't know what that is, it's like, kind of annual, as a shareholder, you get a vote every year on certain major decisions that occur. Executive comp is often one of those things, and you can see in those filings how a management team is incented. And sometimes it is short term, sometimes it's stock price based. I think Elon and Tesla or something recently, last year had a big grant based on stock price. And to your point, that kind of it's not what management should be focused on. Is that something you recommend folks look at, or is that something that you look at?
It's interesting. I think, I think you obviously need to have some understanding of what the underlying incentives are from a monetary perspective. At the same time, and this partly speaks to my strategy because I'm long term and concentrated. So I don't need 40 good ideas at any given time. I need 5, 10, maybe 15. What I've noticed is that there's companies or really managers like Satya Nadella at Microsoft or Reed Hastings at Netflix or obviously Warren Buffett and Charlie Munger at Berkshire Hathaway. I think there's certain people that if you follow them for long enough, you start to recognize that what drives them isn't the monetary portion of the business as much as a true belief in the vision and the long-term execution of the business. And it's still part of the consideration,
Sure.
but for each of those three people, it's almost secondary at this point. And there's something really interesting about a manager getting to that place where again, Satya Nadella, Reed Hastings, Warren Buffett, they don't need any more money by any reasonable definition. They certainly deserve more if they execute. But in each of those cases, I think if you look at how they talk and how they think about the future, they're really focused on actually executing against the long-term vision of the business. And for me, I think that's really, really powerful versus someone
Interesting.
who, is really focused on the incentives of hitting, whatever KPI they need to hit the bonus for, FY22.
Yeah.
So
And to your point, you can kind of
it's
hear
not,
that.
yes, it's not something that's totally quantifiable, right? It's just it's a feeling that you get from following a company, following a manager for long enough. But I think it's a slight tweak that really liberates them from a lot of the short term pressures that your average manager probably faces.
Yeah. I think that's not something I had thought about before. I had a my old one of my old bosses used had mentioned. I heard him say that before. Is that like when somebody, and this is it's a tough thing to talk about, right? Because most people don't really reach this point, and it's because it's very difficult and sometimes takes a lot of luck in terms of getting to a point where money is less of an object. But it really does kind of free up somebody's decision making where you're not, we were talking about this before we started recording. Professional money managers always are kind of, I think you've written about this a few times, kind of, you at least mentioned it in your Substack, that money managers often are making decisions with their career in mind, right? They're thinking like, oh, I can't have redemptions happen. Oh, I can't underperform, otherwise it's going to look bad on me, and then that influences the kinds of decisions that they make. Um, and when somebody is kind of freed up from that and they don't have to worry about their family, or for retail investors it's kind of retirement or something like that, it can be, or you're not investing with money that you need in the next 3 or 6 months, it can kind of free up your decision making to where you're making less emotional decisions and less short term decisions, and really kind of able to kind of keep that like longer term focus, and that kind of like keep your kind of longer term goals in mind. I haven't thought about it. That's a great point though in terms of like management teams. It applies everywhere, but it definitely applies to managers. So we briefly talked about kind of your investment philosophy, and we're going to get back to that. But something that I want to kind of start talking about is how you arrived at this. You said that from kind of an early age when you first got into kind of this business or this world, you kind of early on had this philosophy, this mentality, and I've read through a lot of your stuff, and This has developed even since you've started writing, as we all do. Kind of learn and change, and I'm not going to say adapt to the current market, but kind of learn more about yourself and what works and what doesn't, and things like that. But where did you get started? How old were you when you kind of started? When you knew about stocks, when you knew about the investment world, not just stocks, but the kind of investment world. Was it from an early age? Was it in college? What was your beginnings?
Yeah, I think I've always had an interest in business, and the independence that came with having a significant amount of money was always something that appealed to me, which I'm sure is true for the majority of people. In terms of really getting to know about investing, as far as I can remember, it didn't really start until I was in college. Um, I originally went to school for building construction. My dad's a plumber, and I went to school for building construction simply because I didn't really have any other thoughts on what I should be doing. I
Sure.
realized fairly quickly that wasn't the route for me. Taking a physics class certainly helped in that decision. It was something that did not sit too clearly with my brain. Maybe there's just something about the way I think.
Yeah.
Around that time, I stumbled upon the Berkshire Hathaway shareholder letters, and that was I think that was in 2007, I believe. So it's been 15 years now of just constantly being obsessed with this single topic. So around that time, I switched my major to finance, and as I was finishing up school, I tried to get a job in the industry, whether at a mutual fund, hedge fund, whatever it may be. And the response I got for every resume I sent out was basically the same, which was, "Hey, when you're 25 and you have a CFA and an MBA, come back and talk to us." And that was a bit of a problem because I had to get from A to
Yeah.
B. So around that time is when I started writing online, and I was just trying to really build up my resume. After doing it for a little bit, I got an offer to start writing somewhere and making a little bit of money, and I should emphasize the word a little bit, but it was a lot for a college kid, so
Sure.
I happily took that on. Eventually got a job in the industry, went back to school, MBA, CFA, all that jazz. But as I kept working in the industry, I also kept writing under a pseudonym because I had really come to value the thinking required to put something in written form, and also the feedback from readers. And it's just something I found greatly valuable in terms of my education as an investor. And some of the things I've written in the past turned out to be very wrong and or very poorly written, but that was just part of the education. So fast forwarding to last year in April 2021, I decided to leave the industry and just take all the work that I was doing as an equities analyst and make it available to subscribers. And I tried to make clear from the outset with an article that I called "Returns and Lessons Learned," where I kind of focused on some of the most notable mistakes I had. A big selling point for me for the service was, yes, I have industry experience. I've been writing a long time, so hopefully that has led to uh, the output being a little bit better and being something worthwhile for people to pay for. But also the idea of me being completely transparent with people and showing them, even if you're a novice investor who's been doing it for a year or two, or even just getting started, I've been doing this for 15 years and I still make plenty of mistakes, and I'm still very much at a point in my life where I'm trying to learn and get better. And I suspect that will never change, but it's part of the journey that's really enjoyable. And obviously we all want good investment returns, but
Sure.
this ability to learn together and keep getting better is really been one of the greatest benefits of starting this service.
I think that's a good point. It's almost like I listen to the Lex Friedman podcast a lot. It's something that he brings up every once in a while, and it's that people that declare themselves experts oftentimes kind of, or claim they don't make mistakes. That they kind of always are covering themselves and be like, oh well, this is why I did this. This is why I did that. Kind of that's kind of a red flag for me personally, because to your point, we're all always learning, and that exists both in this world, the investing world, but it also exists in honestly almost every aspect of life, right? You could say between relationships, whether it be your day job, friends, hobbies, like, there's always an ability to, like, you should always be wanting to learn more. And I think it's funny that, kind of the investing world, the stock market, what there's a joke or a saying that the stock market is the most expensive place to learn about yourself, because you will learn monetarily very quickly a lot of things about yourself, biases that you have, kind of an incorrect opinion. So it's like, yeah, kind of seeing, for folks that see the Ackmans of the world, and not saying anything bad about him, he's had an amazing track record, over the years. But those that kind of declare themselves experts and always trying to cover themselves, it's kind of a red flag, and kind of like, oh, well, it's okay to admit when you're wrong. It's okay to make mistakes. How else do we learn than through mistakes?
Yeah, and it's very, the other thing too, just adding to it, it's very black or white in some ways, and even the best amongst us have, I mean, Warren Buffett's investment in IBM or Dexter Shoe, other things he's done, and Ackman with J.C. Penney and Valiant and other names. Like every investor, even the best investors in the world, will have black marks on their record, and I think to run around and pretend like that's not going to happen to you is obviously quite absurd. And the idea, instead of trying to completely avoid those things, is when they happen to learn as best you can, and try to minimize the likelihood of that happening again in the future. And that's all you can realistically do.
Yeah. No, I 100% agree. The biggest thing that you can do, the worst thing that you can do with an experience is not learn anything from it. Right? No matter how negative or positive it is, the worst thing that you can do is not learn from it. Then it's wasted.
Which is easy to do in investing, because I think it's a good Seth Klarman comment about balancing conviction and humility. By definition, when you go out and buy an individual stock, especially if you make it a meaningful position, you're effectively saying that you know more about this company's future or the valuation than the market does. And sometimes you may be right, but there's other times where you may be wrong. And making that transition from having the conviction to actually put the position on and to risk your hard-earned money, to then getting to a point 6, 12, 24 months down the road where you go, oh crap, I was the one who was wrong, the market was right. That's a skill of sorts that you kind of need to learn. And as far as I know, really the only way to learn is through personal experience. But if you don't learn that lesson, you're setting yourself up for a life where you're constantly trying to tell the market that the market's wrong. And if you're actually wrong on a few of those decisions, it's going to lead to some very bad outcomes.
I'm so glad you brought that up, because that is something that I think is like one of the most difficult things, aspects for people to learn. And it's exactly what you said: the difference between knowing when you're wrong and the market's telling you that you're wrong, or that you think that the market's wrong versus that you are wrong. And sometimes it can be very difficult, right? Stocks moving down on you, you see all these negative headlines, but you believe in the business thesis, you've listened to management, you've done all the work, and then something happens 6 months later, and it's like, oh crap, I should have seen that coming. Things were deteriorating. Those short-termisms that I thought that everyone was just focused on actually were indicators of long-term business. How have you learned that over time? Like, kind of like you said, having conviction. I know you've written about it. Kind of, you used to double down harder when things were starting to, maybe not look as positive. Are there any bright line examples that you have in your head, or kind of how has that process been for you over time in terms of learning? It's kind of trusting yourself, right? On how much to trust yourself, and I'm sure that it's led to doing more work on companies to really ensure that you have like belief. But if you could talk about that a little bit, I think that's a very difficult thing for everyone to figure out.
Yeah, I think before I talk about how I address it, I think one of the key parts that makes it so difficult, especially if you're a long-term investor, is that you want to react to things that actually impact the long-term health of the business. And when you go through a period, I mean, not even ones that are outside of a company's control like COVID, but let's say one that's inside of the company's control and they're underperforming. Let's say Dollar General starts reporting comps or same store sales that are weak relative to what Walmart's reporting, or someone like that. It can be very difficult to try to bucket that in your mind between whether this is just a blip that's an ordinary course of business, and sometimes you're winning and sometimes you're a little bit behind, or if it's something bigger that needs to lead to a change in your thesis. I think the way that I mostly try to address this is through my writing, and trying to be very clear with myself about what the thesis actually is, and then trying to take that qualitative thought, like, hey, this is a great management team or it's a great business, and trying to quantify it to some extent, which isn't always easy to do.
Sure.
But I think usually you can put markers in the ground. A decent example right now, it's not a company that I own, but it's one I follow, called Ollie's Bargain Outlets, which is, it's a closeout retailer. And the short Ollie story is their co-founder passed away in late 2019. It led to a lot of questions or concerns from investors about the ability of the company to source merchandise, which is really the key value add that they bring to the table. They can buy closeout merchandise effectively, and then they can sell it to people at prices that are, call it 50% below what you pay for a somewhat comparable product at another store. He passed away in late 2019, which led to a lot of questions about their ability to source merchandise effectively. Then COVID happened. They got a massive tailwind at the start of COVID. And now, fast forward 18 months, that tailwind's completely faded. And if you look at the results, they've really started to lag a lot of what I would consider their retail peers in terms of same store sales. And, for me, it's the kind of thing where, as a younger investor, you just go, okay, the stock's down a lot. I still believe in the company. I'm just going to buy more. And that may end up being the right decision here. But for me, I kind of step back and go, the gap between the company's performance and who I consider their peer set is just too large, even if that's a somewhat arbitrary term, but it's just too large at this point in time for me to put more capital or any capital into this idea. I need to understand what's going on. And if that means the price is 20% higher once I understand what's going on, I think that's just the cost of a part of investing. And maybe you just pay a slightly higher price, but you actually truly have conviction in the thesis. You're not just doing it based on reacting to price action. And that's something that's really important to learn, because I look at some of my biggest mistakes, and maybe investing in the company in the first place was a bad idea. But I think where I really hurt myself was aggressively buying down into price weakness without the justification from the business results for doing so. Maybe the most applicable thing I've done to try to address this problem is to basically set a rule for more patience in terms of how I think about these decisions. Whereas in the past I might have made a position 5 or 10% of my portfolio, it goes down a lot, I'm going to add another 5 or 10 percentage points to the position. Sure. I just don't think about it that way anymore. I think, hey, maybe I'll add slightly more. Let's increase the position size by 10% total. But if I'm right about the business, then I'm going to do just fine in the original purchase, and this little incremental buy will be okay as well. But the focus is to be right about the business, not to try to bottom tick the stock price.
Yeah, who was that the professional manager that you quoted about? He had limits in terms of how much he's able to add on like time frames and things like that. I thought that was really interesting.
That's John Hempton of Bronte Capital, who, well, first of all, he was just on a podcast called Risk of Ruin, which is a gambling podcast, but he was just on there, and it was a fantastic appearance. The other thing to note about John Hempton is, I don't know why, but he seems to have a big problem with Bill Miller, who was famously the hedge fund manager who had a very strong track record, but then during the financial crisis, which is very pertinent to this conversation, basically averaged down aggressively, mostly into financials, and effectively blew himself up or took a major hit from doing so. So regardless of whose side you want to take, Hempton or Bill Miller's, I think you should probably learn a lesson from what happened to someone who objectively was a very, very, very good investor and still is.
No, that's it's kind of having rules for yourself to kind of control emotions almost, right? It's like we're all emotional creatures. We all have conviction. We all have belief, and you get excited about a business, right? You get excited about a management team. They're saying all the right things. They're doing all the right things. But then something doesn't quite feel right, and you want to just double down. You want to say, okay, like, no, the market's wrong. But to your point, you already have a position. You're already set up, you're going to profit regardless. You're kind of trying to make marginal gains at that point, right? Like you're kind of trying to get that incremental dollar, and that chasing can be very dangerous in kind of in any style of investing.
That word is so important, marginal, and it speaks to probably one of the main things I see from investors, that I just don't think the amount of time and attention focused to decisions that are so marginal in terms of, hey, I'm going to increase my equity allocation 5 percentage points. I'm going to go from 60-40 to 65-35, or I'm going to marginally add to the position in company XYZ. The amount of time that's spent on decisions that do not materially change the long-term results of your portfolio is somewhat astounding to me. And I think a great addition that people can have to the way they think about investments is to really look at the decisions they're making and go, is this actually material, or is this just something I'm doing for, kind of short-term worries, or, because I think it maybe is a halfway decent idea. To the
Yeah.
extent you can push that stuff to the side and just really focus on decisions that you think really are meaningful, I think it is a huge change in the way that you think about, again, news flow or changes in stock prices, et cetera. It really allows you to focus on the long term and to focus on making decisions that you actually want to make, that you actually have conviction in.
It's funny. It brings like two things to mind. One is like when people talk about oh, I'm adding Facebook here at like 180, or I'm doing this. I'm just like little tiny little buys. Oh, I bought a couple shares here. It's like what are you doing? Like you're trying to time the market. You claim to be a long term investor, and again, we all fall prey to this kind of thing. You do an exceptional
Sure.
job of kind of preventing yourself from doing this, but like you can't help. Sometimes it's just the dopamine and the kind of it kind of drags us in a little bit, but it clutters your brain so much that when
Yes.
it prevents you from thinking about the important things. Versus then you're watching stock prices every day and you're watching every tick, and not even that, maybe it's like maybe you're not quite that like short term, but like it just it clutters your brain so much. And another thing that it brought to mind is I used to work at a fund, and they would bring through an annual compliance like meeting, and would bring in somebody that got caught for insider trading. And what they always brought up was how little money people were trying to make on this insider trading versus the risk and like how negative the outcome was. And it's
Right.
like, they were doing all this crazy stuff. Like there was the guy that was like passing notes in Grand Central, in Grand Central Station in New York, and like, he was doing all this stuff, and it's like he ended up making like $200,000 from it, which is a lot of money. Don't get me wrong, but he ended up, going to jail and kind of getting banned from the securities industry and all this other stuff. And it's like you're putting so much effort in to make very little with such negative consequences. And now to tie that back to this, it's like you're focusing so much effort on this little thing to make a little bit of money that can drastically clutter your brain and prevent you from kind of seeing the bigger picture and seeing the long term, which is your whole life that we're all investing for, right? You're through retirement and things like that, just to make a
Yeah,
couple of
that's
bucks here and there.
that's really the point, right? It's the idea of, hey, I really like Facebook. I think the investment thesis is still valid. It's down another 5%. I'm going to add here. Like, I think that's perfectly logical in my mind. The problem is when you start becoming so obsessed with what it's trading at that, I see people tweet stuff like this all the time. It turns out they'll say something like, "It turns out Facebook at 180 was a great investment opportunity." And it's like when you really step back, the price is maybe 20% higher than that. If you're talking about where a business is going to be over the course of the next 5, 10, 20 years, these moves are so small. But you start to think in that way where these are 20% becomes a massive move if you're looking at prices every single day. And it just really clutters your mind. And again, this depends on whether or not you want to be a long-term investor, whether you want to be,
Sure.
you have to decide what's the best fit for you. But for me, if
Sure.
you do decide, hey, I want to be a long-term investor, these things really start to clutter your mind. You start going, hey, I did buy at 180. That was a good buy. Maybe I should trim here now at 225 because I got a decent return. It's only been 2 months, whatever. It just starts taking your attention completely away from what, in theory, you're trying to do.
Yeah, no, it's definitely true. You got to keep it. So it's hard. It's hard, but do you have to keep the kind of
Yeah.
long term picture in mind? So we can go back a little bit, just to kind of again, kind of like your journey through this. So you kind of started writing online, and I guess something that I want to ask there, and it seems like it's been such a great benefit for you. It seems like that's a great way for anybody, even if it's not writing publicly, right? Maybe it can be private in a notebook, private in one of the Evernote or something like that. Kind of keeping like a journal of your thought process to be able to look back. Is that something? I mean, it seems like that was such a very big part of your kind of like learning process. Was kind of being able to go back and review what you said. You were posting online, so you were also getting feedback from folks. Do you think that was like that's been do you think you would be in a very different place if you hadn't done that?
Yeah, absolutely. I think it's been hugely. I mean, obviously now it's my full-time career came from
Yeah.
doing this, but just from as an investor in terms of thinking about ideas and communicating, even communicating to yourself really, because putting something down in writing requires a clarity of thought that you don't have when you're just sitting there and thinking about it with yourself. You think you have it, but then when you go to put it on paper, you recognize sometimes, hey, that idea is a little wishy-washy. Is this actually true, or is this just something I concluded based on anecdotal experience, et cetera? So yeah, writing for me is massively important, and I try to encourage as many people as possible to do it. To your point, it doesn't have to be public, even if it's you writing a paragraph on, as Warren Buffett famously said, with, I think he used the example of GM. You're going to buy the stock today. You're going to buy Microsoft at $280 a share. Write down in one paragraph why you think that's a logical decision, and it gives you something to come back to 6 months, 5 years down the road to look at. And as someone who's done that with investment journals, you realize that your views on things change in ways that are uh, not detectable. You don't think your view is changing, but then you go
Right.
back and read what you wrote, and there's times where you go, wow, what I believed a couple years ago is quite a bit different than what I believe today. And it's really eye-opening.
Yeah. Is it like perspective changes? Is it things that you've learned? Is it what things did you notice in yourself changing over time?
A big one is stuff like valuations, where you'll say something like, I think I specifically wrote, and this is many years ago, but I think I specifically wrote in an investment journal, Microsoft's at $25 a share. I'm going to buy it because I think fair value is $35 a share. Which, that may have been a somewhat reasonable estimate at the time, but with the benefit of hindsight, it's funny to think basically that estimate was probably a little bit too pinpoint and wasn't properly thinking about how an investment actually works. And that really influences how I think today. I'm not big on, company XYZ is worth $60 a share. I'm more of the mindset, here's a reason why 50 to 80 may
Right.
be a reasonable range, and then kind of thinking about it in that light.
Right. Because I think you write about this. You've written about this is that kind of valuation, while important, right? While important, because you can have a lot of future potential priced in. I mean, I think you see that a lot in these like SaaS names these days. It's right, like that are Cloudflare trading at 30 times sales and things like that. It's just like God, so much is baked into that price. Like it could be the best business in the world, but like there's so little room for error at that like valuation. Maybe they do take over the world, but it's you're so kind of aggressively priced. It's like how can you kind of benefit from that in the long term? But at the same time, oftentimes, like you said, kind of within ranges, it's like okay, if they get to these numbers, if they execute, if they hit the EBITDA, like kind of what they're aiming for. Well, okay, if it's at 10 times or if it's 15 times or 12 times or whatever it may be, I'm still going to be ahead. Like, right, even if the market kind of ends up kind of pulling back on these names, if they're executing, then I don't need to depend on valuation. I can just depend on execution and depend on business fundamentals, really,
Right,
and
right.
not unless what the market's opinion in that given day is about that given company. Um,
Yeah.
so you came out of school and you were kind of writing online to start building a track record. You got a job in the industry. What were some of the when you first kind of got into the business, what were some of the things that you learned about it? Did anything like kind of demystify kind of once you were kind of in the business that you kind of had preconceived notions about how the professional world operated, and they were kind of brought to light, or negative or positive? When you were young, coming out of school and kind of getting that first job in the industry.
Yeah, so my first job was at an RIA that was very small. I think we had maybe $10 million of assets when I started there, and it was really more family money than anything else. And the gentleman who was running it was going to start trying to stand up a business, basically. So as a result, when I joined, my roles ran the gamut. I was the research analyst, saying, hey, we should buy XYZ or sell ABC. I was the trader actually doing all the trades. I was the secretary getting coffee and mailing account statements at quarter end. So I basically got to do everything, which is fantastic. I had the flexibility to
Sure.
really look at whatever I wanted to look at. I was able to study for the CFA at work. all those things. So it was a fantastic role for someone like me who basically wanted to be given a desk and a paycheck and said, go tell us what to do, because I had the drive and interest in trying to figure these things out. So I basically just went there and sat at a desk every single day and did my best to figure that out. Um, After I went back to school, got CFA, all that fun stuff, then I moved to a bigger firm. I was part of a 4-person investment team where I was still given a ton of flexibility to look at what I thought was most relevant to look at, within reason. Obviously, I wasn't looking at like $5 million micro caps because we had to invest a decent amount of money for our clients.
Sure.
But I still had a ton of flexibility in terms of what I could look at, which again for me was I would prefer that over compensation, the freedom to look at what I want to look at and to try to give my best insight on these ideas. I think what happened over time, and this is just a reality of the investment business, and it has different shades at hedge fund, RAA, mutual fund, whatever. The key concern in the business is gathering assets and and growing the fee base and keeping clients happy, which is a very reasonable thing to want to do. It's important to have happy clients. The problem is when having happy clients runs into what is a thoughtful long-term investment decision. And one thing I really learned, both internally, even as part of the team, but also especially in communicating with clients, is you can't transfer your conviction to somebody else. You, if I've sat there and done the work for a month on company XYZ and the stock's down 20%, and I have a really strong belief that this is just short-term noise and it's a great investment opportunity, it's almost impossible for me to convince you to have the same conviction in that idea as I do because you haven't done the work. um, and that was a problem that I never figured out how to adequately address, and it created a lot of for me, it created a lot of consternation because I'm thinking, hey, I'm doing all this work and it's hard for me to get my opinions to be reflected in how we position. And
Sure.
I think some of that is just being young and not being great at communication, and some of it is just having unrealistic expectations about how a portfolio is getting managed relative to the incentives of the firm. Anyways,
So yeah, I mean, you started kind of writing this your Substack and doing this full time last year. So you spent a decent amount of time kind of fighting this internal struggle to a certain extent, right? Like where you have this like belief and opinion and kind of philosophy, and yet you were in this business that, to your point, happy clients, asset gathering. I mean, whether people like it or not, hedge funds, RIAs, things like that, they're businesses, right? They, we always look at corporations and say that they should do what's best for the bottom line and, you know, ideally long-term growth, and not just, people get mad about them for ESG and things like that. But, they are profit-focused entities, and same thing with RIAs, same thing with hedge funds, same thing with private equity. Um, but it's almost like starting to get into like, industry structure, right? That like the way that the asset management industry is currently structured is wrong, sort of. And how exactly, that's a whole other conversation to get into, like how to change incentives for managers to get them to focus more on long term, so on and so forth, which is a conversation for another day. But that must have been difficult, kind of dealing with that kind of dissonance at work and in terms of how you wanted to, how you believed things should be done.
yeah, and it's there's a number of layers to this. One important thing to say first and foremost is that some of the ideas that I brought that I had high conviction in probably didn't work out too well. So it's one of those things where, hey, the firm had a structure because they recognize what clients care about, and even if I disagree with whether or not that's the appropriate approach to reach the objectives that I think should be the objectives, they have to operate in the structure of what their clients are comfortable with. And that's another big point too. I've toyed around with this idea of writing a book about how to pick an investment advisor, essentially, and how to think through getting help for investments if you decide you're not going to do it on your own. And I haven't finished this book. I've tried to write it, but one of the key messages is you as the client are the one of the biggest problems in this equation. You need to have realistic expectations about what a manager can and cannot do. They can't outperform every single quarter if they're actually active. They can't outperform at all if they're effectively just running a closet index portfolio. They're just going to be in line with the index, which you can be happy with or you cannot be happy with, but you need to have realistic expectations about what the what the service is going to provide, what that RIA can actually do for you. And that's where it gets really, really difficult in my mind, because client education is a very, very difficult thing to do. And I think in some way it's easy for me to say this as an outside looking in, who wasn't responsible for the P&L. I was just an employee, but it's where it really requires an RIA or a fund manager to say, listen, I don't think you're a great fit for what we're trying to do. I'm more than happy to try to explain what we're trying to do, but it's just not going to work if you don't have realistic expectations. It's a very hard thing to say when somebody walks up and has a $10 million account they want you to manage. So
It's hard to
as with
turn
everything in
away.
life, yeah. So it's like most things. It's not black or white, but I just found for me, and maybe it's just the firm I was at, maybe it's just the industry generally, but I just found it was becoming too painful for me to constantly bang my head against the wall. Um, so I'm glad I moved on to my current role where I can
Yeah.
just kind of talk about what I'm doing, and if people disagree with it, then that's life.
Yeah. Do you, I mean, on that point of RIAs and kind of people looking for investment advice and things like that? I mean, you lived in this business. It's not a business that I was in. We ended up dealing with mostly institutional clients, which have their own issues on their own. When I say institutional, I mean like pension funds and a couple sovereign wealth funds and things like that. And they have their own similar issues, but you would think that they'd be more educated, but sometimes they're not. Um, do you think that like the RIA kind of wealth management industry? Do you think that's you were in it and now you kind of disagreed with it? Like, what is your opinion on it? Is it the right path for people? There's also all these like kind of new age like wealth front and things like that. Like, what I'd be interested to get your opinion on all of that.
I think I think the RIA industry, generally speaking, can serve a very important function for the average investor. The question in my mind has always been, and I think it's fairly obvious from looking at the numbers or the results that people get, what is the actual value add? The real value add comes from financial planning and having clear thoughts about a long-term asset allocation, things like that. Things that are incredibly important and that are not that hard to do if you have, sufficient understanding and practice in finance slash investing. But a lot of people simply don't have those tools, and
Yeah.
their asset allocation will be out of whack. When things are going great, they'll be overexposed, and when things go bad, they'll sell out at the wrong time, et cetera, et cetera. So it's fairly basic stuff for people who have been in the industry for a while, but it could be a huge value add for your average client. So I think RIAs 100% can play a role there, and I don't think it's something that's easily replicated just through technology or forced actions in a portfolio. There is something to be said for having an advisor that you work with who is someone you actually trust, who can you can talk you off the ledge. Um, the security selection part's a lot harder, because part of the problem, and it speaks to what I kind of said at the outset of what kind of investor you want to be, most RIAs, in my experience, don't have clear objectives of what they're actually trying to do. Are they trying to outperform? Are they active investors? Are they throwing you in a bunch of different asset classes and a bunch of different sectors, so you're broadly diversified and you have a couple different ETFs? You get to a place where are you passive? Are you active? What is the objective? And that's usually very unclear. The outcomes, generally speaking, are not great, and it really suggests that the most logical approach would just be to focus on financial planning, asset allocation, et cetera, then fulfill the needs of the portfolio with ETFs or whatever it may be. The problem, I think, is that clients start asking questions when you start doing that. What exactly am I paying you for if the idea here is you're going to put 40% of my portfolio in VTI or some market index, and it's not going to change for the next 20, 30 years? Why am I paying you 100 bips a year? The right answer is because what we're going to do for you on the financial planning and behavioral finance side will justify that cost. And I think that's pretty defensible in terms of actual data.
Yeah.
But that's a hard thing to say when someone says, my guy down the street had me in Tesla and it went up a lot. And you get into these conversations again, like we spoke about before. I had this position. Sure, it was a 10 basis point position. It didn't actually do anything even though it went up 10x. It didn't have a big impact anyways, but you have to have the right frame of mind to understand what that even means. So it's a very difficult problem, but I think the RIA industry definitely does add value for the right client. It's the security selection stuff where it gets a bit squirmish.
Yeah, it's expectation setting, right? If everyone has the right expectations for what you're going to get, and it can happen on both sides, right? It's like, an RIA could be very upfront with you and tell you that this is the value that they're going to provide through financial planning and things like that, that we're going to put you in this basket of ETFs. But then the client gets mad later on why, they're underperforming or whatever it may be. Or the other way, where the RIA oversells their ability to beat the market, and then that doesn't end up being true, and then it kind of creates this friction. It's all about kind of expectation setting. If everyone is aware of what's kind of being done, obviously there can still be friction on both sides. But at least at the very beginning, you as an RA can kind of go to somebody and be like, look, this is what I told you. This is what I told you I was going to do. This is what I am doing. If you're not happy, you can leave. And otherwise, I'm going to continue providing you this value.
Yeah, and I think at the end of the day, and this is a hard part of being an investor, right? I mean, I publish my returns to the people who subscribe to my Substack, and there's times where that's not fun to do.
Yeah.
But it's a reality of being an active investor. I think a lot of RIAs effectively just kind of try to put their head in the sand and let's not even think about the fact that actually being in the market over a long period of time is a very difficult thing to do. And it's more of a let's just not pretend it's real type of thing. And I just don't think that's not a useful way to go through life in any field or any endeavor. It's not being honest with yourself and not seriously thinking about what the problem is just not an effective solution.
Yeah, no, that's definitely. I definitely agree with that. Acting like something isn't happening is never gonna help you. So going back to your kind of, I want to, kind of, I don't want to. I mean, I could have these kinds of conversations all day. But kind of your investment philosophy, and the one thing that I know you touch on is kind of your circle of competence, like your kind of your area of competence where you feel like you have the right knowledge and things like that. And you also talk about, you kind of have a list of what a high quality business is to you, and it ends up filtering out a lot of investments, but that can actually also be a good thing because it constrains you can miss opportunities, but at the same time, it's much more focused. How do you define your area of competence? How did you find a competence? How did you find that? Because it's different for everyone, right? A software developer that's lived in tech, well, their competence could be all the data dogs, the Zscalers, the CrowdStrikes of the world. They're sitting there in the tech company. They're actively using these tools. They're actively, making the purchasing decisions depending on where they are in their ladder. How did you kind of find that over time? And what would you? And I guess like a broader question is, what would you define as your area of competence?
Yeah, I think a big part of it, especially when you're a newer investor, which I still, even after 15 years, I still kind of consider myself that in a lot of ways. It's a lot of it is just testing the boundaries, right? And starting. That doesn't necessarily mean making investment decisions, but going out and reading about companies and trying to, like I'm doing work on Roblox right now. A lot of it is foreign to me, and I'm definitely not the target demo, at least as the product stands today. But I think just taking the time to actually read through it and try to learn, you can get to a place where you go, maybe this is within my circle of competence. I might not be able to predict the future of this particular company or the industry, but I think I have a general understanding of what they're trying to do and why it could potentially work very well at scale. So I think in a lot of cases, it's just taking the time to truly do the work and then being honest with yourself about, for example, obviously a drug company, if it's a single drug that's going through trials and predicting whether or not that's going to be successful, if that's kind of a definition of circle of competence, then that's going to be a really tough one for me to ever get past that hurdle. Everything else is, as I've said a couple times now, different shades of that, between the black and white in terms of what you're comfortable with. In terms of what I put in there today, I think retail's an industry that it's not necessarily great businesses, but there's companies in there that I think are unique and that I can certainly understand that I've followed for some time.
Sure.
Media is another place where I think the world is changing in a certain way that presents a lot of really interesting opportunities for certain companies. I think financials and insurance is an area that I have a lot of interest, even though it's definitely something that's harder to get your arms around than understanding why Dollar General can generate good economics on that next box that
Sure.
it builds. So it varies, and I think to our discussion earlier about being in an RIA, especially a big RIA, the idea is that in my role, I kind of had to look at, or that it was understood that I would look at, would be kind of the bigger names, the well understood, well followed companies. How much of that was real versus me imparting that idea in my own head, I'm not sure, but now I have more flexibility to kind of look at things that are a little bit smaller, a little bit more
Yeah.
outside of what I would have probably looked at previously. So it's taken me quite a while, but I'm slowly but surely removing that constraint and trying to kind of expand the circle of confidence.
Yeah, and you said it with like, starting with like Netflix and Spotify, like you kind of you list your the kind of what you define as a high quality business, and admit that all of your investments don't necessarily at this moment meet those four criteria, Spot
Right,
and Netflix being those two. But kind of you've
right.
really taken the time to understand them and kind of go through them and think about them long term. Roblox is an interesting one. What is your process been there? Are you on Roblox now? Do you have an account? Have you played it?
So actually, the article is going to come out. I don't know when this is going live. It's going to go out next
Okay.
Monday. I guess it'll be like the 18th or something. I'm not sure.
Okay.
But yes, I actually did create a Roblox account. Um, I found it I have found it a bit confusing.
Okay.
As someone who grew up with Dreamcast and
Yeah.
Playing FIFA on Xbox, playing Roblox on a PC is a little bit foreign to me. And that actually, I'm still writing it now, but that actually is a big part of the introduction of the article. I basically say, I found the experience somewhat underwhelming, but then I also go into the idea that what I'm looking for out of this platform is different than what the core demo is looking for, and I kind of give some of the examples. And this is a business now that has 50 million daily active users, so something's working.
Yeah.
And kind of to how I approach the exercise, it's similar to how I approach every kind of new idea that I look at, which is I like pulling the key numbers, key income state data, key cash flow data, and then especially the KPIs for the business, like the number of users or the number of stores, revenues per user, revenues per store, et cetera. I like to pull all that data for as far back as I can go and let the numbers kind of tell me the story of what this business has become over the past 5, 10, 20 years. I think it's a really effective way to kind of clean slate your own biases and other people's views on what a business is, to just very clearly step back and go, okay, no matter what I say about this business, they've gone from 15 million daily active users to 50 million in like 3 years. There's something happening here.
Yep.
It may not be for me, but there's something happening here. And maybe with some work, I can try to understand that. So
So I imagine
that's
that's
kind
very
of,
much like trying to put yourself in the target demographic shoes, right? Is trying to
yeah,
see it through their lens, and that could be not just
yeah,
apply to Roblox. It could be any company. It's like you're investing in a beauty products company or something like that. It's like, look, I don't use this stuff, like, but
right,
yeah, you kind of have to be able to put yourself in their shoes, and okay, like I imagine like reading articles and kind of reading testimonies and things like that in terms of whether beauty products people people online reviewing them, things like that, and okay, like what are they looking for, what do they want out of this? It's not what I want, but like what do they
right.
want? It's very not an easy thing to do, honestly.
Well, that's one of the beauties of today's world too, right? And we've kind of talked about this throughout this conversation a little bit, how the professional investor and the individual investor, how they kind of compete, for lack of a better term, or where their advantages and disadvantages lie. And I think the individual investor has a significant advantage in terms of their ability to think long term, to not worry about mark to market returns over 3 months, 6 months, whatever, which is a massive problem for RIAs, hedge fund managers, et cetera. Here's another example I think that's really important, and it speaks to how I do my own research process. The information advantage in terms of short term stuff is probably still huge. I mean, professional investors have access to credit card data and a bunch of other stuff, some of which is probably above board, some of which is probably not above board, if I had to guess, but that's just me guessing. When you get to the
Yeah.
long term stuff, when you get to the long term stuff, I think it's a lot less clear that they actually have an advantage. Um, and speaking to what you just said, I've reached out to like 10 or 15 developers on Roblox. There's no reason why I can't understand the value proposition of Roblox for a user. I can ask my cousin who's like 10 years old, who's obsessed with this thing. I can reach out to developers and find out what they see valuable in the platform. There's no informational advantage in my mind that the wealthiest hedge fund in the world truly has over an individual when it comes to kind of long-term investing. I mean, anybody can get expert transcripts now or access to investor days, et cetera, et cetera. So I just think if you have the right frame of mind and you're focused on answering kind of those long-term questions, the advantage that anybody has over you is, at least to me, not very evident. And again, they have to constantly worry about those those short-term blips. I mean, what's the famous chart? I think it's Amazon, maybe it's Netflix, of the massive stock performance over 10, 20 years.
Yeah.
But it also shows that they've had like 10, 50% drawdowns.
Yeah.
And a
Amazon,
good
I think it
question
is. Yeah.
a good question to maybe ask yourself or think about is would you have been able or willing to hold through all those periods? And there's hedge fund managers who'd probably say, no, listen, I'd have to try to trade around that. I can't live through that 50% drawdown for a big position. So you're really advantaged as an individual if you can let some of those things not be of concern to you.
Yeah, it's kind of like it's your superpower, right? As a retail investor, it's the thing that you have over the industry, and I don't think it's talked about enough because the amount of pressure. We've both had the fortune of working kind of in the industry and seeing it firsthand. But you know, for those that haven't, it is real. It is very difficult. It's no fun getting on a call with a client that is pissed, that is fired up and ready to yell at you. They just want to yell at you. They got yelled at by their boss and they want to yell at you or whatever it may be. And it is not something you as a retail investor have to deal with. If you're smartly investing your money, we talked about this I think before we started recording. Don't invest the next 3 6 months of money that you need. If you're looking to buy a house, and this is where you talked about like financial planning and where RIAs can be very helpful. If you're planning on buying a house and you have $20,000-$30,000 saved up for that, you don't need to invest every little dollar, because what if we do go through a correction like COVID or something like that, and all of a sudden it wipes out your ability to buy that house, and then you're in a tough spot in terms of life. Maybe you have another kid on the way and you need the space, and all of a sudden because you wanted to make that extra 5-10% by having your money invested, all of a sudden you're in a tough place. Well, then you just lost your advantage that you had over professional money managers. You just lost it. You gave it away. Your ability, your superpower is that long-term ability and not having to worry about short-term performance. And I
Yeah.
think the more that we take advantage of that superpower, I think the better that we all can be.
Yeah,
Alex,
just
appreciate.
just
Yeah, go for it.
just adding to that point real quick. I mean, that's when you get into the advantages too of, like you said, someone who works in an industry or someone, you're an early customer of Amazon or Netflix or whatever it may be, and you
Yep.
can really take a long-term perspective on, where a company may be able to go over time, and you don't have to sit there and worry about what Amazon's going to report for operating income next quarter. It's completely
Right.
irrelevant. If you recognize the business opportunity and you see that they're clearly outcompeting their competitors, and you have some semblance for how it becomes an attractive business model over time and scale, you can completely disregard all the other stuff within reason.
Yeah, and like to the point of like area of competence is that especially if it's like an area that you're actively in, it's like I see this, like I know how much value this is providing. Again, I
Right.
bring up the software developers just because it's the hot, sexy names these days. But it's like you see a new product, that Datadog or someone releases, and you're in that industry, and you're like, no one else understands. This is a big deal. It's not going to
Right.
next quarter bring on big earnings gap. It's not going to be in even maybe 6 months. But I live this every single day, and people do not appreciate how big of a deal this is. Not that can apply to any industry, industrials, manufacturing, whatever it may be that you have experience. Retail, it's like Revolve or somebody comes out with a new product line, and all your friends are clamoring to buy it, and it's like you don't understand. People don't understand how in demand, how popular this is going to be, and you can
Right.
take advantage of that kind of thing.
Yep.
I think it can be very powerful if you kind of allow yourself those things, and kind of trust yourself, right? To believe in yourself, to
Yeah.
believe in your own perceptions, your own intuition, and things like that. Don't don't let anybody take that away from you. Almost like it can be one of
Yeah,
the most powerful things that you can do.
yeah,
Um, so last question I wanted to ask you before we get you out of here is how do you find new opportunities? I think that's like always kind of a difficult thing at times. With Roblox, was it your 10-year-old cousin kind of or whoever was like talking about it all the time, or was it that you just came up on Twitter all the time and you're like, you know what, I need to take a look at this thing. Like it's people freaking talk about it incessantly. Like, let's see if
yeah.
this thing's real or not. How do you kind of what is that process like for you to find something and to spend the time to actually spend a couple of weeks looking into the company, however long
Yeah,
it may be.
it tends to be pretty sporadic, is the first answer. With Roblox specifically, the seed got planted in my head because I saw the cousin I was talking about who went on a family vacation a year or two ago, and I saw him playing, and I didn't really know what it was at that point in time, but I saw him playing, and I quickly recognized that the accessibility and the low cost of the platform, and presumably the ability to work across a variety of hardware, was a very unique approach to gaming that stood out to me relative to kind of the world I grew up in, where you go buy a console for $500 and you buy games for $60 a pop. It just struck me as something very unique, and to see a young kid doing things on there that weren't even necessarily gaming, like tweaking an avatar and things like that. It just struck me as a unique behavior that didn't really make sense to me, but that's been true for every kind of air quotes old man who's ever got passed by what the next generation dreams up and finds relevant. So that definitely stuck in my mind when I saw that. And then my good buddy Francisco Oliveira has been following Roblox closely since the company went public, and he's the kind of person, you have those friends where when they say look at an idea, I procrastinated for a bit, but when he's someone who says look at an idea, it's something worth looking at. So I finally did the work, and kind of to your point on the decision to make it a weeks long project, that starting point of plotting the financials, as I discussed a few minutes ago, that's a big part of that decision of whether or not I'm really going to go deeper and truly understand what this is, or whether it's just there's something about these financial results that doesn't give me the excitement to keep with this exercise. And again, that partly speaks to my emphasis on business quality and long term prospects over is the valuation cheap. So yeah, that's how I stumble upon these things. And sometimes it says, I love the example that Warren Buffett gave. Even though the investment didn't work out in IBM, he said something on CNBC like, "I've been reading the annual reports for 50 years. There was something in this one that kind of turned the light bulb on for me," and that happens to me a lot with ideas that I really get interested in. Example: Spotify, when they disclosed that, I think it was the original Investor Day, that their engagement was significantly higher than what peer platforms were seeing from their users. Obviously, they had a larger user base as well, but something about that idea really stuck with me and made me want to dig into why that's the case. And my own answer to that question is a big reason why I think it's a good investment. But
Yeah, no, that's. I think that again speaks to trusting yourself, the things that you observe, the things that you see, whether it be in your own industry. You walk into a store and it's packed, and kind of makes your head turn sideways a little bit, or you go to buy something and it's out of stock, and you're like, oh, that's kind of odd. Like, why? Those can be the best, some of the best indicators. And to give again credit to the retail investor, you got to remember a lot of these Wall Street, a lot of the professional money managers, where are they? They're in New York City, and they don't quite have the same, maybe perspective or kind of view of the world. They live in a bubble, and guess who all their friends are? Also, other Wall Street folks, and they kind of live in this echo chamber, and us kind of being more distributed, and then also hearing it from others through platforms like Twitter, right? It's like somebody posts a picture of something be out of stock. It's like, okay, well, that's interesting. It's information, right? It's always something that you can kind of take in and then go to your local store and see it for yourself, or whatever it may be.
yeah, a lot of
I
this
think
stuff,
that's often not talked about enough.
right? Just adding to that point, I mean, it's a great example. You can you can fairly easily go visit five, Ollie's, Dollar Generals, Dollar Trees, Family Dollars, and get an actual feel for what the shopping experience is, understand what the consumer value proposition is, which it's not the same for all four of those. in some cases actually very different. But you can get a feel for those things and understand them in a way that, and again, this is like investing in a business for a long term, truly understanding what the business is, not guessing whether next quarter's sales are going to be up 6% or 4%. This is the type of insights that, in my mind, can compound over time and actually have a shelf life, as opposed to a lot of the stuff that Wall Street analysts are forced to focus on because it's basically their job, is just stuff that's completely irrelevant after 90 days.
Yeah,
So
that's 100% true. Well, hey, Alex, I really appreciate your time talking with us, kind of walking through your process, kind of where you came from, and kind of how you learned over time. For anybody that doesn't, definitely check out Alex's podcast, or his Substack and his Twitter. It's TSOH Investment Research and TSOH Investing, I believe is your Twitter handle. And I think your investment philosophy that you have up there, you posted it recently, is free. If I believe that's right.
yeah,
So anybody
investment
that's
philosophy is free, and I have a couple of deep dives on there that are free as well, so people can really get a sense for the way that I think about the research process and investing generally. Which, I've said before, my only objective is to get subscribers who actually will find value in the offering. So people should definitely read those things before they consider signing up.
Yeah, and I'm sure, not to put you out there, but I'm sure if anybody has questions, they can DM you and kind of,
100%.
I'm sure, and kind of, as part of this journey, kind of learn. And
yeah, I'm always available.
Questions. But all right, man, I appreciate the time very much. We'll close it out here, and I'm sure I'll speak to you again soon.
Thank you.